Hey everybody, today we're going to talk about lenders. There's a lot of discussions and arguments even about the difference between private money lenders and hard money lenders. So, in my opinion, just in the 5 years of experience that I have in the industry, there really isn't any difference. People will often say a private money lender is somebody like a friend or family member or somebody that's an individual. That is also the same case as a hard money lender who can also be an organization or a company that loans money from a fund, like a private equity fund. There are over hundreds of companies that do this, and there is no difference between them or a hard money lender. Sometimes you'll people will get angry about this and actually try to argue the point because they want their narrative to fit the case when it clearly doesn't. So I want to just kind of make sure that people understand that. Now, the other thing about lenders is that they all are going to have specific requirements and guidelines for their products. If they are a company and not an individual, they are often tied to what they are telling their investors. They're people that fund them, whether they're a limited partner, they're an accredited investor. And we'll get more into that on other discussions that we have in the future, what's the difference between LPs, GPs, KPs, and also accredited investors and what they are and how they qualify. But for what we're talking about today is that a lender who's going to lend money from their fund generally has an agreement in their private placement memorandum and their operating agreement with their investors. It says, hey, we're only going to lend money at 6%, 8%, 10%, whatever the case may be. Right now, I'm going to say that most of the lenders that I know are going to be 10% or higher, and they're going to base their tiers on usually credit. They're not looking particularly on a credit, even though it says, hey, don't use your own credit. You don't need to worry about credit score. You do. I mean, if you have a 500, you're not going to get financed by anybody. Most of the lenders that are going to invest at you just want to generally know what range you're in. If you're a 600, a 650, or a 700. For example, one particular lender that I've actually got my training from as a private money broker has a tiers. There's different factors. It's like it's like one of those charts that says if you do this, if it meets this qualification, do this, but if it doesn't go this way, um, it's it's like if you've got experience, if you got 5 flips, if you've got a 750, or sometimes a 720, then you can get like 10%, and you get a much better financing package, obviously, than if you have zero experience and you have zero. And your credit score is like under 700, you might get as high as 15%. You always want to think about the money that you pay as an expense, as a part of the deal, part of doing business, and evaluate it as part of your when you find the opportunity. So if you go and find a property that say is off market or on market, and you can get it at a low enough price with the purchase price, your rehab costs, your carrying costs, that it becomes economically viable. So many people are at the 65% or higher range when they factor in all their costs. And I tell you what, all you're going to do is have to bring more money to the table than your down payment and your closing costs. Closing costs can be wrapped. A lot of lenders can wrap them into the deal, but some of them don't. So for the premise of this video, we're going to say that closing costs are separate. So if you find something that's like 50% or under ARV, you get your purchase price. Most lenders will go up to 90% of purchase price for a flip. They'll usually go up to 80, 85% if you're going to do a rental. So if you're going to do a flip and you can find something that's going to total with your closing costs and all your, those expenses, you can be under 65%. That's just going to help you uh, find more lenders who want to lend you money. You should be able to build a package to compete for their business. We're in later videos. I'm going to start going through processes. We'll do some case studies. We'll show you some different examples of some that are some very risky deals to what's a very solid deal. We almost limit the risk. I'm going to tell you right now, and you've heard me in a couple other videos talk about Privy. You definitely want to get Privy if you're in the single family space. If you're going to do flips or rentals, that's getprivynow.com, and you can contact Benson Juarez and Tell him you got his contact from me, got my name, and Benson is Benson at teamprivy.com. And Benson will hook you up with a demo. He can actually show you some incredible deals. He just showed us some that were 25 or 30% of ARV, now. And by the, you factor in the purchase price, your rehab costs, and all that stuff, you could be under 50%, which is a great deal. You're going to find a lot of lenders and a lot or investors to find money for you. I'm going to say that if you're looking for truly for 100% financing, I'm sorry, it's really not out there if you're just starting out. You're going to find some people that maybe want to do JVs with you. And, getting started as a JV, maybe it's not all the money in the world, but if you can find somebody with money to be a JV partner, that's going to be an easier situation to find than find a lender that's going to give you money at 100%. You generally have to pay for a program. There's a couple programs, one out there, it's like $15,000 and you get 50-50. So you still have a JV situation and you got to pay the 15,000 up front. There's another one where you pay $3,500 and it's got some, I can give you the contact information for both these companies. They have their pros and cons. There's also a program that's actually I do highly recommend, because if you take a master's program from another one of my contacts, you take any of their 4 master's programs, you can get 100% financing across the board up to, you can do 4 properties. It's phenomenal. You get 100% across the board. And I can put you in contact with them as well. So if you're interested in that, just tell me about, that you want to get contact information on those three providers. With one company, you can, they got so many programs, and I went through my private money broker training with them and certification. So I can highly recommend them. I wouldn't be here if it wasn't for the training that I took with them initially when I got into this business. So I wanted to pass that on to you. But finding a lender isn't like finding somebody on Facebook or somebody and going, hey, you're not going to find a lot of people that are actually legitimate. What you want to do is, if you get somebody who's actually claiming to be a lender, you want to ask for their HUD-1 form. The HUD-1 form, especially if you're in the single family realm, HUD-1 is even used in regular mortgages. It's a closing document that the title company prepares, that basically it's the chart. It tells everybody where the money's going. It basically gives them pay direction of pay, and where different things are paid. The broker's fee is going to be towards the bottom. But if you can get a HUD-1, it can, some information will be redacted and blacked out, but you can ask them for HUD-1s to prove that they're legitimate. If they hesitate to give you, then question them. You also want to check and see if they've got, if their LLC or the corporation's registered, if they have a website, things like that you can check out to verify, besides just references. Because I can tell you, I've just coming from the construction industry before I got into real estate. I one time had to verify insurance coverage for a contractor, a subcontractor, and they basically produced an Accord. Accord is a type of a form used in the state of Colorado for insurance liability or workers' comp. It's a certificate, and they produced a fraudulent one, and a lot of homeowners would just have said, "Oh, the certificate's good," right up until you need the coverage, and then it's not good. So I'm going to teach you guys in the scope of works videos on how to verify your subcontractors, your general contractor, and stuff. So that's for another day. But getting back to lenders, those are the keys to finding a legitimate lender. I have a list of close to 250 vetted and verified lenders as of May 1st, 2022, just a few weeks ago. They were all still in business. We had a virtual assistant contact them, and so we have their name, we have their contact email, phone number, in some cases their addresses, what state they lend in, or what states they don't lend in, and what their programs are. So you have that already in the database. So you can go through and look at them. You could actually create your own database by importing the data into your own Excel, and find maybe 10, 15 lenders that you want to contact. You always want to have a relationship with your lender or investors before you find an opportunity, because then you can structure your offer for for that particular investor or a couple of investors or lenders. That way you've got 3 to 5 options, which I always recommend you have 3 to 5 options. It's very important, so you can go in and say, hey, this lender's going to do this, but I'm going to have to put this down payment. I know what their closing time frame is. So when you go in and let's say you have a month or 30 days or 15 days, or if if you're doing a sheriff's sale, you have 24 hours. Sometimes that day you have to pay the escrow, the deposit and all that, the EMD. So we'll teach you more about that in another video. But you want to basically have that relationship so you can structure deals off that. So when the seller or their representative accepts your offer, that financing is going to be in place because you've already contacted the lender or the investor and you've already got the parameters and their guidelines, and you can write that deal knowing that that is going to be um, approved. You want to think like their underwriter. And once you start developing a relationship with the underwriter and the processor and the top, you also got the closing agent and in some cases the transaction coordinator, you are going to find an immense amount of success taking more opportunities and closing them as deals. And then you're going to be able to do your rehabs, or do your improvements, whether you flip or rent, whether you're doing multifamily, self-storage, assisted living, short-term rentals, new construction. It's going to make things a lot easier for you. You're not going to be scrambling on there and who's legitimate, who's not, having to vet that thing. So I would go ahead and join. If you if you like our Facebook, facebook.com/the OPM show, and you've also got our Facebook groups, which is facebook.com/groups/other people's money show. If you go to those and you join our group, you're going to have the lenders list and a lot of documents. By the end of June, I will have hundreds of documents on there that you can download. Many of them you can white label. You can go in and get the Word version or the editable version where you can put your own information in there. So it becomes your form. These have already been lawyered up. They're already working. There's going to be a lot of different forms and templates in there for you. And lists, like I said, the lender list is extensive. Generally speaking, if you reach out to me and you got a particular situation, I may be able to direct you to a couple of lenders that I know that would work for that situation. You also have the opportunity, if you wish to engage my services as a private money broker. It's a simple non-exclusive agreement. I get paid on contingency at closing. So I'm going to look at the situation and go, is this viable for me? Because I'm going to spend my time trying to help you get it financing. I'm going to have a checklist that you have to meet for those particular lenders, and you have to go down the checklist and check off everything. And we're going to go more into that in a video. So if you wish to engage my services, I do get paid by the lender only, not by you. You don't ever even give me 1 cent, and I get paid at closing. That is an offer to you as well. But generally speaking, I'm trying to teach you either how to do DIY, the do-it-yourself model, or you can engage a private money broker or myself. So I'll talk more about that in another video as far as what our services are besides, because we don't just private money broker. We can do a whole lot of consulting as well on that for you. So once you have your private money broker or you have a lender arrangement or an investor, if you're looking for 100%, you might have to find a JV partner or an investor. Investors, especially on larger deals, if you have a large deal and you don't have any money of your own, you're going to have to find somewhere. If you do 100% financing, if you're able to find it, you're giving something else up to get that. In the cases where you sign up for a master's course or you sign up for a program, you're giving up sometimes a fee. And these companies that I will say, even though there's some pros and cons, they're legitimate, but there's some pros and cons, and you got to understand that, and you got to make your decision based on that arrangement and what you feel comfortable with. And I can direct you in 3 different ways as far as that goes. But like I said, as far as 100% financing out there, if you're brand new, you're not going to find it unless it comes at a high cost that maybe, is it worth it if you're just getting in to break in? Because I can tell you, once you have 5 flips or you have a few properties and you do the real estate experience Excel spreadsheets that I have, you're going to find a whole lot more success finding really good financing. I mean, you might get under 10%. Right now on a flip, you're on a flip property, you're looking at 10%. a minimum. You might even go as high as 15 or 16% with one of the lenders that is actually newbie friendly. That is the key. If you're new and have no experience, you're going to pay more. But once you get experience, then that's just going to help you. Like I said, we always want to go back to the ease. Equity is important once you have your experience and you have an executive summary and all that, and you have, you've got to basically do a number of things. Experience helps a lot. Once you get experience and all that, you've got a good executive summary, and then you have an exit strategy for everything. What is your exit strategy? What is your contingency? What are you going to tell them? What happens if you're going to do a rental property? Are you also prepared to sell the property if you're not able to rent it? Are you able to then sell it, liquidate it, still make a profit while repaying your investor? So sometimes in there talk about what your contingency is. You got your exit. My planned exit is I'm going to rent it, and in 12 to 18 or 24 months, I'm going to refi it. And then, because at that point, once you refi it on a rental property, you can often find Freddie Mac or Fannie Mae backed federal financing. Once you have that in place, you can get a 30-year amortized loan, and you're going down to 3 to 5% right now. It is going up with interest rates rising, so don't hold me to the 3 to 5%. But you can get a 30-year, 10-year, 15. You can get a fixed interest rate on your rental property once you basically have it seasoned. If you're just buying your first property, you're probably not going to find that. But you can also do that if you're doing multifamilies, if you're doing like a fourplex or a duplex, triplex, or you start getting into where you start talking about doors. Doors are units, it's apartments, multi-units. You can, once you start accumulating doors, and you can start converting that over to long-term amortized financing, which will drop. And so you always want to use that as a strategy in rentals, because you're going to get a high, the entry into getting that unit's going to be higher. But if you can go in, you can do your rehab, you get your tenant, and then you basically in 12 to 18, 24 months, sometimes you can then refi that into your long-term deal. Your initial lender or investor will get paid off, they'll get their return, and you basically then just move into a much better deal, then just rinse and repeat, and that's how you scale. We're going to have more and more videos going as we go along explaining this to you. So I look forward to teaching you more about that. If you have any questions, please leave them in the comments, or you can find me on Facebook, and you can also reach out to me, Nate at natemarshallcapital.com. I also ask you to like, share, and subscribe on this YouTube so that we can build this network, and we can I'm building this platform for you. And like I said, I'm going to have a new webcam in a couple of days, and another so the video will get much better. So I apologize a little bit that everybody's got to start from somewhere. So I thank you for your patience and for your time. And like I said, if you've got any questions, feel free to reach out. Again, I ask you to like, share, and subscribe. Thank you.